Friends, today we will discuss Unit 10 of International Financial Management, that is Cost of Capital and Multinational Capital Structure. Let me first tell what is the objective of my class today. After discussing this unit, you can identify peculiar features of MNCs, peculiar features of MNCs, and you can analyze the forces contributing to differentiate cost of capital across countries, and you can describe the process of determining cut-off rate of foreign project appraisal. We'll discuss all these things one by one. First, let me tell you what will be the structure of my discussion. First, I will give an introduction to the chapter. Then we will discuss cost of capital of MNCs vis-a-vis domestic firms. How cost of capital calculation is different for MNCs and domestic companies. Then we will discuss discount rate for foreign investments. Next, we will discuss establishing worldwide capital structure. Next, we will discuss valuing low cost financing opportunity. Next, we will discuss capital structure and cost of capital, what is their relationship. Next, we will discuss how and why financial manager use this. And we will have some references and self-assessment question. This will be our structure of discussion. Friends, what is cost of capital? Cost of capital, generally in a business, capital is required. And there are certain providers of capital. The providers of capital may be equity or debt holders. The equity holders are the owners of the company. The debt holders are the creditors of the company. Equity holders provide ownership capital, whereas debt holders provide loan capital. But whoever provides capital, he expects something. The minimum expectation that providers of capital expect from the business is known as their cost. Hence, cost of capital refers to minimum rate of return a firm must earn on its investment. Cost of capital is a cut-off rate for allocation of capital to investment projects. We know that in case of capital budgeting decision, what is capital budgeting decision? It is the decision regarding investment in fixed assets of an organization. In case of capital budgeting decision, we discount the cash flows of a business. We discount the cash flows of a business at a rate. That rate is known as minimum rate, required rate, or cost of capital. So, the cost of capital is normally used as a cut-off rate for evaluating capital investment projects. Okay, it is the minimum required rate of earning or cut-off rate of capital expenditure. The cost of capital is the rate of return that a firm wants to earn from the capital employed or from its investment proposals. Okay. So this is also reflect the minimum rate of return required to maintain the market value of the share. What does it mean? Very important point. If a firm earn cost of capital return, if a firm's return is greater than its cost of capital is K, then in that case, the many people will be interested to buy the shares of the company. Okay, so in that case, there will be increase in the market value of the shares. If ROI is greater than KO. If ROI is less than KO, people will not be interested to invest in those projects or in those companies. In that case, they will sell the company share. So it will lead to decrease in the market price of the share. And if ROI, return on investment, is equal to KO, what will happen? The share price will not increase or decrease. It will be maintained. So market value of shares will be maintained. So a farm must try to earn return greater than its cost of capital so that there will be steep and continuous increase in the market price of the shares, which is reflected through its market capitalization or its wealth maximization objective. When there will be wealth maximization objective will be fulfilled only when the ROI of the business is greater than its cost of capital. Now we will discuss what is the main point of difference between calculation of cost of capital for a domestic firm and for a international firm with or for an MNC multinational company. Now there is some key features for MNCs which must be taken into consideration while calculating cost of capital of an MNC. The first point of is the scale of operation of MNC is higher than the domestic firm. Normally, MNCs operate in a larger scale than domestic firms. Okay, and MNC obtain the funds at lower cost from international market. Normally, domestic firm raise its fund from the domestic capital market, whereas MNCs raise their funds from different international financial markets where cost of fund is minimum. The operation of MNCs are diversified globally, as a result of which their overall cost of capital is usually lower in comparison to similar firms which operate only in domestic business. Okay, but there is some catch with MNC. MNC's cash flow are subject to exchange rate risk, so, as a result of which, creditors and stockholders demand higher return, which enhance MNC's cost of capital. So, these are the two major features. First feature is MNC obtained from different markets where cost of capital is low, but at a similar time, MNCs face exchange rate risk, which increase their cost of capital. These two things must be considered while calculating the cost of capital of an MNC. Now, first we will discuss what is cost of capital. There are two sources of funds. One is debt or loan fund, another is equity or own fund. So, what are the sources of fund? Sources of funds are two. First fund is own fund, which is known as equity. Another is loan fund, which is known as debt. The cost of equity is known as cost of obtaining equity is cost of equity, which is symbolized as KE. And the cost of debt is cost of debt, that is KD. Once we calculate cost of equity and cost of debt, we can find out overall cost of capital. How overall cost of capital is calculated? Overall cost of capital is known as KO. How KO is calculated? KO is equal to weight of equity into cost of equity plus weight of debt into cost of debt. We will apply this and we can find out overall cost of capital or KO. How KO is calculated? Weight of equity into cost of equity plus weight of debt into cost of debt. Therefore, what is weight? Weight means proportion in the capital structure. Weight of equity is equal to equity value divided by total capitalization, equity plus debt. And weight of debt is equal to debt value divided by equity plus debt. So as we use weights and calculated the cost of capital, this is known as weighted average cost of capital, which is known as WACC. So while calculating cost of capital, our main purpose is to calculate WACC. But how WACC will be calculated? First we have to calculate cost of equity, then we have to calculate cost of debt, then we have to calculate weight of equity, then we have to calculate weight of debt, and we have to apply the formula KO is equal to weight of equity into cost of equity plus weight of debt into cost of debt. And once we calculate this, we find out overall cost of capital or the cost of capital of the entire business. Normally, a finance manager must try to reduce KO, reduce overall cost of capital. So we are discussing regarding cost of capital. Cost first we will discuss cost of debt. What is cost of debt and how it is calculated? We know debt provides loan capital. Okay, these are loan capital. There are certain features of debt or bonds or debentures. Debt are in form of bond and debentures. What are the features of bond debentures? Okay, first, all these bonds debentures has a face value. What is a bond or debenture? Bond or debenture is a part of loan capital. Bond oblique debenture is a part of loan capital. We know the part of own capital is known as share, whereas part of loan capital is known as debenture. Debentures or bonds are the loan bonds of the company. These are the creditorship security of the company. By giving debentures, company take loan. So debentures or bonds are issued to raise loan capital, and all these debentures and bonds have some face value. This face value is the nominal value of the debentures. Okay, and this face value are the denominated value, and the face value are used to compute interest. In case of debenture, the interest is calculated as certain percentage on face value. Let's take an example. Face value of a company's bond is 100 and debenture is 9% debenture. So interest will be 9% of face value. 9% of face value. What is 9% of 100? That is equal to 9 rupees. 9 into 100 by 100. 9% is 9 rupees. Next one is interest or coupon rate. Each and every debenture has an interest rate or coupon rate attached to it, except zero coupon bonds or deep discount bonds. These are the two bonds where coupon rate is not there. But in all other debentures, coupon rate or interest rate is there. The coupon rate is applied upon face value to calculate the interest for the debenture. Next, maturity period. Each and every debenture or bond has a maturity period. What is the maturity period? After that period, the debentures are to be repaid back. This is known as maturity period. Normally, with debentures which has maturity period is known as redeemable debentures. But there are certain irredeemable debentures where there is no maturity period. But practically, there is no such concept called irredeemable debenture because practically people do not subscribe to this type of debentures. Practically, most of the debentures are redeemable in nature, which has a maturity time. After that time, the company has to pay back the money to the debenture holders. Next one is redemption value. What is redemption value? The value at which payment is to be made on the maturity date. The redemption value may be more than or less than or equal to the face value. Normally, practically, it is either equal to face value. If redemption value is equal to face value, it is known as redemption at par. If redemption value is greater than face value, it is known as redemption at premium. So the debenture may be redeemed either at par or at premium. But redeemable debentures have a redemption value which is different from face value. If redemption value is less than face value, it is known as redemption at discount. But practically, redemption at discount is not possible. Next, tax shield benefit. Very important. The interest on debenture is treated as a business expenses. Interest paid to debentures are recognized as business expenses. When it is treated as a business expenses, then it will be put, then profit will be found out upon which the tax is paid. So the person it pay interest, it saves some amount of tax. The saving in tax due to payment of interest is known as tax shield. What is tax shield? Let's take an example. Suppose you pay a interest on debenture 20% or 2000. You pay 2000 rupees as interest on debenture and your corporate tax rate is 30%. That means by paying 2000, you put an extra expenses of 2000 upon which you save a tax of 30%. Therefore, tax shield will be 30% of interest on debenture. That is equal to 30% on 2000. That is equal to 600. Am I clear? This concept is known as tax shield. Now we will discuss how to calculate cost of capital of redeemable debenture and irredeemable debenture. First we will discuss regarding irredeemable debenture, then we will discuss regarding redeemable debenture. In case of irredeemable debenture, what is irredeemable debenture? Where debenture are not to be redeemed. Irredeemable debenture. What is cost of debenture? Cost of debenture is calculated with the help of the following formula. What is the formula? KD is equal to, KD means cost of debenture, I whole into 1 minus T divided by NP. Let me explain what is this formula. KD is equal to I whole into 1 minus T divided by NP. KD means cost of debt or cost of debenture after tax. What is I? I is annual interest payment. What is NP? NP means net proceeds from issue of debenture. How NP is calculated? Suppose a debenture of 100 rupees is issued at 3 premium. So 100 plus premium minus issue expenses. Suppose 100 rupees debenture is issued at 5 rupees premium and issue expenses is 2 rupees. So what will be net proceeds? Net proceeds will be 103. So how net proceeds is calculated? Face value plus premium minus issue expenses. This is the concept of calculating NP or net proceeds for irredeemable debenture. What is T? T means tax rate. You will apply this formula and find out the cost of irredeemable debenture. Similarly, if you have to calculate the cost of redeemable debenture, how it will be calculated? Cost of redeemable debenture. In case of redeemable debenture, you have two things. One is redemption value, another is net proceeds. You will find out redeemable debenture. Cost of redeemable debenture is equal to I whole into 1 minus T. What is I? Interest whole into 1 minus T. What is T? Tax rate plus RV minus NP by N whole divided by RV plus NP divided by 2. This is the formula. This is plus RV plus NP by 2. This is the formula. What is KD? KD means cost of debenture. What is I? I means annual interest payment. What is T? T means tax rate. What is RV? RV means redemption value. Redemption value may be at par or may be at premium. If it is on par, face value is equal to redemption value. And if it is premium, face value plus some premium, you get redemption value. Then what is NP? NP is net proceeds we have discussed. What is N? N is life of the debenture. This is the formula you will apply and find out the cost of debenture which is redeemable in nature. This is how we calculate cost of redeemable debenture and cost of irredeemable debenture. Next we will go to calculate cost of preference share. We know that the ownership capital is known as equity. The equity can be obtained through issuing equity share or preference share. There are some unique features of preference share. The preference shareholders get fixed rate of dividend, and most of the preference shares are redeemable in nature. There may be irredeemable preference share, but it is out of fashion today. So most of them is redeemable preference share. But in case of preference share, one thing is there, you have to pay dividend, and dividend is not tax deductible item. Dividend is not an expenses, it is an appropriation of profit. So how to calculate cost of preference share? Cost of preference share will be calculated very easily. That is KP is equal to preference dividend plus redemption value minus NP divided by N whole divided by redemption value plus NP divided by 2. The same way we calculate the cost of debenture, we can calculate cost of preference share, but in case of debenture there is interest, here will be PD. What is PD? Preference dividend. In the formula, in the above formula, there was a concept of interest, but in this case the concept of interest is not there. This is the cost of preference share. Next we will discuss the concept of cost of equity share or cost of equity. It is very important to calculate cost of equity, but it is very difficult to measure cost of equity. What is cost of equity? Cost of equity is the discount rate that investors think is equal to the present value of all the expected future dividend per share. Why there is importance difference between cost of equity and cost of preference? Now, why it is very difficult to measure cost of equity? It is very difficult to measure cost of equity because of the following reason. First reason is the cost of equity is not the true cost of using equity capital. The cost of equity is based on how many dividend shareholders expect in future. It is the link between market price and earnings. There is no single method for calculating cost of equity. There are many methods you will adopt to find out cost of equity. What are the methods? First method is dividend expectation method or dividend price approach. What is dividend price approach? When to apply this dividend price approach? You have to apply dividend price approach when dividend expectation is expected to be constant. If expected dividend is expected to be constant, in that case we can apply dividend expectation method. If earnings are expected to be constant, in that case we apply earning price approach. If dividends are expected to be constant, we apply dividend price approach. If earnings are expected to be constant, we apply earning price approach. But if dividend and earning are expected to grow at a constant rate, then in that case we apply a model. That model is known as Gordon's model. But if it is very difficult to expect dividend or forecast dividend in future, in that case we apply a model. That model is known as realized yield approach. So there are four important approach: dividend price approach, earning price approach, Gordon's model, realized yield approach. These are to be used in specific situation where they are to be used if dividend expected is fit to be constant, we apply dividend price approach. If earning expected is expected to be constant, we apply earning price approach. If dividend and earnings are expected to grow at a constant rate, we apply Gordon's model. And if it is difficult to expect dividend in future, we apply realized yield approach. So these are the approaches of dividend. Okay. Next, we'll discuss there is a concept called risk and return. We know that there is a linear relationship between a risk and a return. Equity investment is an risky investment. So more the risk you take in investment in equity, more will be your expected return. And one model is used for factoring this risk of equity and finding out cost of capital, which is very popular. That model is known as capital asset pricing model or CAPM model. CAPM model is one model which is used for finding out the cost of capital of an equity share by considering the risk of the equity share. And the CAPM model categorizes the risk into two parts. What are the two parts of risk? One risk is known as systematic risk. Another risk is known as unsystematic risk. So there are two types of risk: systematic risk, another is unsystematic risk. What is systematic risk? Systematic risk is a market risk which is applicable for all the players in the market. Market risk. Unsystematic risk is a unique risk which is applicable for a particular company or for a particular sector. Suppose there is a strike in your company and this type of risk is unique to your company, so this is on systematic risk. But if there is an increase in the interest rate, it affects almost all the companies in the market, so it is a market risk or systematic risk. The on systematic risk can be reduced through diversification. Through diversification, it can be reduced. What is diversification? If you do not put all your money in one share, that is known as diversification. You diversify your investment in different shares, so the unique risk is phased out. So this is known as own systematic risk. And the systematic risk cannot be reduced through diversification. So this risk is the actual risk or vital risk or relevant risk for CAPM risk model. This is the vital risk for CAPM model. And this systematic risk is measured through a concept that is known as beta. So what measures the systematic risk? Beta measures the systematic risk of the particular security. And CAPM model tells that there is a linear link between risk and return. What is risk and return? Beta and return. Okay. And this model is based upon three parameters. So CAPM model is based upon three parameters. What are the three parameters of CAPM model? The first parameter of CAPM model is systematic risk. What is systematic risk? Beta. The second parameter of CAPM model is that is a risk-free return. What is risk-free return? Government security return. We can call GSEC return. That is RF. Another is market risk premium. What is market risk premium? The third parameter of CAPM model. The third input required to apply CAPM model is market risk premium. It is the difference between market return and a risk-free return. So for CAPM model, we require three things. First, we require beta. Next, we require the risk-free return. Next, we require market risk premium. That is the difference between market return and risk-free return. If we apply all these three, there will be a linear relationship between a risk or systematic risk and a return of this security. So what is the formula used to calculate the return, the CAPM model? First one is expected return of the security is equal to RF plus beta I whole into RM minus RM. What is this? What is RI? RI is equal to expected return on investment. What is RF? RF is equal to risk-free return. What is beta I? Beta I is the beta value of the security. And what is RM minus RF? RM minus RF is the market risk premium. That is equal to RM minus RF. And if you apply this formula, you can find out the expected return of any security. Expected return of any security can be found out by applying this particular formula. RI is equal to RF plus beta I into RM minus R. This is known as expected rate of return. The beta value may be greater than 1 or less than 1 or equal to 1. If beta value is greater than 1, the asset is less volatile in comparison to market. If beta value is greater than 1, the asset is more volatile in comparison to market. And if beta value is equal to 1, the asset's volatility is same as market volatility. Okay, so there can be high beta stock, there can be low beta stock, there can be equal or equi beta stocks. So this is CAPM model. And there is another model that is known as dividend capitalization model of calculating cost of capital. What is dividend capitalization model? How cost of capital is calculated with the help of dividend capitalization model? The dividend capitalization model, you require three parameters. What are the three parameters? In this case, you require three things to find out the cost of equity. First thing you require D1. What is D1? D1 is expected dividend after year 1. And how D1 is calculated? D1 is equal to D0 whole into 1 plus G. What is D0? D0 is equal to current dividend. And what is G? G is equal to growth rate of dividend. And D1 is required, D1 is calculated, and you require another is P0. What is P0? Current market price. So three parameters is required. One is D0, another is G, another is P0. If you know this thing, you apply the formula and find out the cost of equity. Cost of equity is equal to D1 by P0 plus G. Cost of equity KE is equal to D1 by P0 plus G. You apply this formula and you find out cost of equity. What is D1? D1 is equal to D0 whole into 1 plus G. What is P0? Current market price of this share. You apply this and you find out the cost of equity under dividend expectation model. Next, we will discuss weighted average cost of capital. I have discussed already what is weighted average cost of capital. Weighted average cost of capital is known as WACC. How weighted average cost of capital is calculated? Weighted average cost of capital is calculated with the help of a formula. Formula is equal to weight of equity into cost of equity plus weight of debt into cost of debt. These are the cases. How weight of equity is calculated? Weight of equity is equal to equity value divided by debt value plus equity value. That is equal to total value. And weight of debt is equal to debt value divided by debt value plus equity value. And how KE is calculated? KE is calculated as per any model, either CAPM model, नहीं तो dividend capitalization model, dividend based model. Next, how KD is calculated? We have discussed KD is calculated cost of debt, I whole into 1 minus T. And all these things are there. You can apply the formula and you can find out weighted average cost of capital or WACC. In this way, you can easily calculate weighted average cost of capital. Okay. Next, we will discuss what is discount rate for foreign investment. Normally, for foreign investment, the discount rate has two different meanings. First, normally the interest rate levied on short-term loan obtained from central banks and other financial institutions is known as the discount rate for foreign investments. It is the interest rate on short-term loan obtained from either central bank or financial institutions that is known as discount rate for foreign investment. Some people try to use weighted average cost of capital for discount rate of international projects. You can use two rates, any one of the two, that is, it will be treated as discount rate for foreign investments. Next, we will discuss establishing the worldwide capital structure. What is the capital structure across the world? We know that capital structure is the composition of debt and equity. How much debt capital you use and how much equity capital you use. What is the composition of debt and equity? That is known as debt equity mix, or that is known as financing mix. A company's value will be maximized when its cost of capital is minimized due to combination of multiple source of funding, that is debt, equity and other form like preference. Thus, a finance manager is constantly looking for an ideal balance of debt equity mix. The finance manager can choose a capital structure that is somewhere ideal, where cost of capital is very less or low. That sort of leverage is best or optimum where cost of capital is low. That is known as optimum capital cost of capital. We know that, suppose here we use cost of capital, or here we use degree of leverage. Leverage means use of debt capital. You can use 10%, 20%, 30%, 40% debt capital, and your cost is there. If your weighted average cost of capital behave like this, you can identify a particular percentage where WACC is minimum. And this structure, that is 20% leverage, is an ideal cost of capital, and this is the best combination of debt equity, where you will use 20% debt and 80% equity. This is optimum capital structure. Optimum capital structure, where cost of capital is minimum. That capital structure where cost of capital is minimum is known as optimum capital structure. So the debt ratio is very important. In different markets, different type of debt ratio standards are used. Normally in United States, the debt ratio is 50%. That means they use 50% debt, they use 50% equity in their manufacturing sector. Whereas it is 75% in Japan, 65 to 70% in Germany. In Great Britain, 60 to 70% is their debt structure. This is debt ratio standards in different countries. Next, we will discuss national financial markets. The degree of financial market development in various nations has a significant impact on how MNC create their capital structures. The capital structure of MNC depends upon different factors. It depends upon their internally generated cash. It depends upon their short term or external funds. It depends upon their long term external funds. These are the three major sources of funds for MNCs. Normally, MNC use their long-term finance from the following sources. First source for long-term finance of MNC is foreign bonds. What is foreign bonds? When a bond is issued in the local currency and follow local rules, regulations, that is foreign bond. In USA, if dollar denominated bonds are issued, that is a local bond. That is known as Yankee bond. In Japanese market, if yen denominated bonds are issued, that is a foreign bond. That is known as samurai bond. Yankee bond, samurai bond. In India, the foreign bonds are known as masala bond. In UK, it is bulldog bonds. This type of bonds are foreign bonds. This is one source of obtaining long-term finance for MNCs. MNCs can obtain long-term funds through foreign bank loans, which we know is CBs, external commercial borrowings, or they can go for FCCBs, foreign currency convertible bonds. They can use for foreign equity. How MNC go for foreign equity? Issuing MNC equity in different market, they can do it through ADRs and GDRs. What is ADR? American Depository Receipts. GDRs means Global Depository Receipts. ADRs are issued in US market, where GDRs are issued across the globe. Next, valuing low cost financing operation. Normally, when you value a firm, the following three parameters you use. First, the valuation of a company depends upon its free cash flow. Second, its operating free cash flow. First, we will discuss what is free cash flow. The free cash flow means the money a business makes after cash outflow is known as free cash flow. The free cash flow can be found out from the income statement and comparing the expenditure and excluding non-cash income and non-cash expenditure. You can get free cash flow of a business. So what is operating free cash flow? Operating free cash flow is the cash OCF is the cash generated by operation that is allocated to each capital provider in capital structure of the company. Operating free cash flow, it is calculated from EBIT, earning before interest and tax. If you will consider and make some adjustment, you will get operating free cash flow. Next, it depends upon the growth rate of the business. What is growth rate? The rate at which company's dividends are expected to be increased. That is known as growth rate in business. Next, we will discuss what is the relationship between capital structure and cost of capital of the organization. So there is a relationship between capital structure and cost of capital of the organizations. In this context, we have to understand the following 5 points. A company with strong capital structure has a better chance of having its shares and debentures securities appreciate its value. A company, if it has a strong capital structure, its cost of capital will be lower. A sound capital structure guarantees available funds be spent efficiently. A sound capital structure increases its profit in form of higher return to stakeholder. A sound capital structure prevent overcapitalization or undercapitalization. What is overcapitalization? If a company employ more capital than required capital, it is known as overcapitalization. If a company employ less capital than required capital, that is known as undercapitalization. So it gives the firm the flexibility to increase or decrease debt capital if needed. These factors must be considered. Next, what are the factors which determine the capital structure of an MNC? The following factors determine the capital structure of an MNC. The first factor is capital cost. What is the cost of the capital? What is the cost of funding? It decides the composition of debt and equity. Next, second is level of control. If you issue debt capital, a company's control is not diluted. Whereas if you issue equity capital, a company's control is diluted. Whether the existing shareholders are okay with dilution of control or not, that decides the capital structure of an MNC. The third point, which decides the capital structure of an MNC, is known as trading on stock or trading on equity. What is trading on equity? Very important point. Trading on equity. When the rate of return on capital exceeds the rate of interest paid to debenture holders or bond holders in form of interest on newly borrowed debt, that is known as trading on equity. Let's take an example. You are considering a new project where 500 crores will be employed, and you decide to raise this 500 crores at 10%. So you have to pay interest of 50 crores. But by applying this 500 crores, you generate a revenue of 12%. That is 60 crores revenue is generated. So this is your ROI, return on investment, is greater than your cost of capital. This is Q. And how much extra you generate? You generate 60 crores minus 50 crores. 10 crores is the surplus. And this surplus will go to whom? This surplus will go to existing shareholders. And this 10 crores they get by employing the funds at 10% and generating 12%. So this is known as trading on equity. Most of the organizations are interested in trading on equity. Next, public policies. What is the policy of the government? That also decide the capital structure of the organization. Okay. How cost of capital is calculated? How weighted average cost of capital is calculated? We have discussed. First, you have to calculate cost of equity capital. Then you have to calculate cost of debt capital. Then you have to calculate weighted average cost of capital. And the formula is very simple. We have already discussed. Weight of equity into cost of equity plus weight of debt into cost of debt. This is used to calculate weighted average cost of capital. Next, how and why finance manager use cost of capital? Normally, finance manager utilize cost of capital known as WACC as a benchmark or criteria for selection of new initiatives of the company as well as evaluation of current ones. That means weighted average cost of capital is used to evaluate new investment opportunities. It is assumed that a corporation is not making best use of investors' capital and is therefore reducing the wealth of investor if it accept or implement plan with IRR less than WACC. That means you have to do those projects where IRR of the project will be greater than weighted average cost of capital. This must be understood. While evaluating the project, you have to apply this rule. The IRR of the project, internal rate of return of the project, must be greater than its cost of capital. Then only there will be wealth maximization or wealth addition to the company. So, while valuing or finding out profitable ventures, you have to apply weighted average cost of capital, and you have to compare the IRR of the project with cost of capital of the project. Next, the cost of capital of MNCs we have already discussed. Normally, the cost of capital of MNCs is different from countries to countries. Certain countries like East Asia allow companies to be more leveraged than Eastern European countries or United States. MNC take advantage of difference of leverage in their overseas operation to enhance return of equity shareholders. And the cost of capital of the MNC is the weighted cost of equity and debt, where weights reflects firm's capital structure. Cost of equity reflects opportunity cost. We have discussed. Cost of equity is the opportunity cost, and cost of equity is always greater than cost of debt in case of MNCs. And cost of debt is the net interest expenses. What is net interest expenses? Interest expenses minus tax shield or tax benefit. And MNC take advantage of difference in interest and tax rates among countries to minimize their cost of capital. Okay, next, there are several peculiar features of MNCs which decides their cost of capital. The scale of operation of MNC is large. The access to global markets is very easy in case of MNCs. MNCs go for international diversification. Next, MNCs are subject to exchange rate fluctuations in their cash flow, and MNCs are return cash flows are more stable than the domestic firms' cash flows, and the exposure to country risk is high in case of MNC. The country risk is also known as political risk. Let's take an example. In Bangladesh, there is a political turmoil and it impacts the farms operating in Bangladesh. So the MNCs which operate, the garment manufacturers of the world which operate in Bangladesh, are subject to country risk or political risk. While calculating cost of capital, you have to go for this. If you will follow this diagram, you can know the cost of capital of MNC, large scale, generate to capital market, international diversification, exposure to exchange rate, exposure to country risk, and all these things have preferential treatment from creditor, possible access to low cost financing, probability of bankruptcy, and all these things affect the cost of capital of MNCs. Cost of capital of MNC, you can follow this diagram. This diagram tells details regarding which factors affect the cost of capital of a multinational company. Okay, in our class today, let me summarize my discussion. In our class we have discussed regarding cost of capital. Cost of capital is the cost of obtaining funds. Okay, always the firm must try to minimize the cost of obtaining funds, and the cost of capital of domestic firms are different from cost of capital of multinational firms. Different factors which affect the cost of capital of multinational firms we have discussed, and cost of capital is important because it is used as a criteria to filter out the international investment projects. We have to invest in those international projects where ROI is greater than cost of capital. These are certain references for further reading on this subject. Thank you. Thank you for attending my class. Thank you all.